Good afternoon, and welcome to our Managing Risk in a Hard Property and Casualty Market webinar. I'm Deborah Hickey, and I, along with Eleanor Baker and the entire team at Carter Financial Management, want to thank you for joining us today. Education is one of our core principles at Carter and key to helping our clients make well-informed decisions. And with that in mind, we want to continue to provide relevant financial planning education and are very fortunate to have Cliff Layfield here with us today. Many of you may be a bit sticker shocked opening your latest auto and homeowners insurance policies. And Cliff is going to explain why and provide some suggestions on what we can do to get optimal insurance premiums as best as we can. Cliff Layfield is a Senior Vice President and Personal Risk Service and Vice President with Personal Risk Services in Dallas. He started with USI in January of 2021, and he comes to USI with 20 years of personal risk management experience. He's experienced in working with successful families to design and implement personal risk management programs that address the specific needs of family by acting in a consultative manner to find creative solutions to property and casualty exposures. Cliff has worked with some of the largest families in the country to restructure their personal insurance program to being better value to the overall program. He graduated from the University of North Texas with a BA in political science and a minor in business administration. And he holds the following professional designations: certified insurance counselor and associate in risk management. And he's been a very active member of the Financial Planning Association of DFW since 2001. And he was the president of the chapter in 2012. And he's originally from Dallas and lives in Grapevine, Texas with his wife. So Cliff, why don't you get your slides organized, and I'll just provide a little bit of housekeeping. We are going to, I'm sure several of you do have some questions for Cliff, so this is a great opportunity. So we're going to leave a few minutes at the end of this webinar. And so certainly you should see a Q&A at the bottom of your screen. And please type in your questions, and we'll make sure to address those at the end. Eleanor will direct those questions after Cliff is ended with his presentation. One thing that you may have noted too is when you were looking at the slides before we started, we are going to have Shred Day again this year on Saturday, April 20th here at our office from 8:30 to 11:30 a.m. And so for those of you who have been collecting those boxes, just, and obviously just bring those over, and you'll be getting more information on that in the next few weeks. Thanks so much. Thanks, Cliff, again for being here, and please take it away.
All right. Can you see the screen?
Yes.
Okay, just want to make sure. Okay, well, thank you, Deborah, and thank you, Eleanor, for inviting me to share some of this information with you and your clients. As Deborah mentioned, there is some sticker shock going on. I can tell you right now that this is probably the hardest, most difficult insurance market I've ever seen. And unfortunately, I've seen a lot. So just to let you know that, and that, in fact, there's less of a light at the end of the tunnel. But hopefully, in the going through this presentation, we'll give you some why as to the reasons for, and hopefully, again, it will make you better informed about making decisions going forward. So again, this is a little bit more about me, my glorious headshot picture. Yay. All right, now the good stuff. What is a hard market? That's a term that's tossed around today a lot, and it's the upswing in the insurance market cycle when the premiums increase, coverage terms are restricted, and capacity for most types of insurance decreases, as opposed to a soft market, which is just the opposite. Insurance premiums are going down. That is a term that has not been heard in a while and may not be heard again for quite some time. But the terminology hard market is what people see and hear a lot on a day-to-day basis. So what's causing the premium increases? The big $64,000 question. This is, good old economics 101. In this case, demand increases and the supply decreases because more and more people need coverages. and the supply is decreasing because the insurance carriers are discovering, much to their chagrin, they're paying out more in claims than they are taking in premium. And that's pretty much an unsustainable business model. And as a result of that, they've got two options: increase premiums or get out of the marketplace. And both things are occurring pretty much simultaneously. Some carriers are getting out of the marketplace in total, or in geographic areas specifically. Others are trying to get rate increases to stay in the game. And that's where we all see our home, auto, and umbrella premiums come in the mail that are exponentially higher. Uh, and obviously, the direct premiums from property and casualty insurance are increasing because exposures continue to increase. People buy homes, people buy cars, and need insurance. Although I can tell you this right now, especially in some geographies, can you say California? There are real estate deals that are going bad because the buyer cannot come to the table with homeowners insurance. If there's a mortgage, the mortgage company says no homeowners insurance, no loan. And that is occurring, especially out in California, sometimes in Florida, sometimes in other places. Colorado is getting to be a bad spot. Texas is not immune to that. So that's causing problems in the real estate issue. In the real estate market is that people can't sell their homes because the buyer can't get insurance for them. Right. Then, obviously, the number of single family homes are increasing. It's somewhat leveled off, but there's a tick up pretty much on an ongoing basis. Same thing with cars. People continue to buy cars. And that's another issue in terms of, how to secure proper insurance coverages. Because again, in most cases, states mandate you have to have automobile insurance. So that's why there's a growing number of those all the way across. So this is what if demand's growing and supply is shrinking, what's the problem? All right. So now we have, like I mentioned before, fewer players in the game. There's a lot of consolidation. There's a lot of mergers and acquisitions going on in the insurance world. And the next slide will kind of shockingly show you that. Less reinsurance. And for those that don't understand it, reinsurance is what insures the insurance companies for catastrophe type losses. If the insurance company, ABC Insurance Company, cannot secure reinsurance to cover catastrophe losses, then they are pretty much out of the game because they can't afford to pay. They don't have the resources and the reserves to pay mega losses. Then that's why they insure those mega losses through reinsurance. And that market has become very tight and difficult in the last year or two. And then the tightening appetite of the insurance underwriters. They are becoming more picky in geographic areas. In many cases, they're saying thanks, but no thanks. We don't want any risk in these areas because, i.e., wildfires, coastal exposures. All of these things are causing underwriters to want to say no. Now, in terms of market consolidation, there's been some activities by the graph of carriers and brokers merging and shrinking the market as we know it. So from a carrier standpoint, here are some names that you probably recognize in many cases that were providers of insurance company, insurance, home, auto, umbrella, business insurance, and the like. So kind of count the numbers. Now look at what left of all that. All those numbers, those numbers have been consolidated into just a very few carriers. All right, so you can kind of do the math and figure out fewer carriers. There's more difficulty in getting responses. I can tell you this time last year, especially from a high net worth space, we had probably 6 good high net worth carriers. Obviously, Chubb was one. Pure, AIG, Cincinnati, Berkeley One were players in the space. Today, we have maybe 3.5 that are still in the game. The others have pulled out and said thanks but no thanks, or non-renewing business that they had. So like I'm telling clients today, if you get a renewal, that's a win. Regardless of what the increase is, that's a win for today. Hopefully things will change better. So you can see there are restrictions in certain states more so than others, and kind of look at it, the West Coast, Colorado, Texas. I mean, I had a client in Idaho that we tried to get some coverage for, and nobody would play because of the fire risk. So anything out west, I mean, now if you think of the Texas Panhandle burning a few weeks ago, although it didn't necessarily affect a lot of property, it did affect some property. And the fact that wildfires are continuously a problem. If you think a few years back in the Bastrop, in hill country, when those fires burned, and it burned a number of homes. So wildfires are a huge concern for underwriters. There are some ways, and we'll talk about some ways to risk mitigate that from an insurance, from an owner standpoint, what you can do as a homeowner to help mitigate it. But the rest of them you can see on the coast. Florida, obviously, being one, anywhere up and down the East Coast, from hurricanes and winds and things of that sort. So those are all playing into why carriers are restricting their business appetite, while they're getting out of the game, and some are going broke. There are some firms especially like in Florida, that are basically paper firms. Clients have pieces of paper that are pretty much worthless because the next storm that comes through, that insurance carrier that's named on the paper will no longer exist. So they're going to go file a claim and find out that they have no coverage. So that's another issue that the consumer needs to be aware of, the financial stability of the insurance company that is actually extending terms. I mentioned the reinsurance problem. So goes the reinsurance problem, goes the regular insurance companies that we deal with. Because again, if they cannot get reinsurance to cover their excess losses, then they severely restrict their ability to do business. And so there is some lightening of their appetite. I mean, the renewal numbers, contracts that came out first of the year were a little bit better than in 2023. So there's some help there, but again, their capacity and to offer terms are usually going to the larger carriers first, and the smaller carriers are left holding the bag. And that's becoming more and more the case unless you're connected to. So capacity is shrinking.
Cliff.
So yes.
Hi, Cliff. Sorry to interrupt, but are you able to kind of move that upper bar and just start from the current slide? I think if you go over there, that would be great, because some people may be viewing this on their phone.
Okay.
So just have a small screen. Thank you so much.
Absolutely. Okay. So again, capacity is shrinking, as I mentioned. More and more carriers are finding it more.
I can only see USI now.
Oh my gosh. Well, this is sick. How we get out of this?
Go stop sharing your screen and share. I don't know what's going on. I can only see your USI screen right now.
Hold on just a second. Let's start over.
Cliff.
No. Okay. Hold on. New share. Let's see if that works.
You know what? That works fine. Don't worry about it.
Okay. All right. I apologize for the problem.
No problem. We're good. Thank you.
All right. Okay. So again, as capacity shrinks, it makes it more difficult for people like you and myself to, find insurance carriers that are willing to offer terms and conditions at any price. And that's the other problem. I mean, I'm finding more and more times I'm having to say no to prospects because I cannot find a solution. And I can tell you this, after this many years in the business, and you can't find any solution for a client is pretty much a kick in the head. I'm just not used to being able to say I have nothing to offer. That just goes against my professional standards. But then that's the unfortunate reality that we're living with today. Again, I mentioned the reinsurance rates are rising. Those are passed through cost. So the insurance carrier that has to pay more for reinsurance has to charge more in premiums to cover that differential. So you can see it's just, the percentages are going up. The best hope going forward is that they stabilize instead of continue to rise. That will allow more and more carriers to at least get some degree of reinsurance and be able to offer terms and conditions. All right. So again, this all gets back to tightening of appetite. Underwriters today are looking for reasons to say no. Any reason to say no is what an underwriter will say. Well, we don't want that risk. So our challenge, and any insurance person's challenge, is finding a solution to a client's problems or issues. Unfortunately, or in days past, we could find multiple solutions and offer the best solution to the client that would meet all of their needs. Today, we're lucky to get one solution, and that's all is what is what turns out to be the only possibility. So it's either that or nothing. So it's property insurance is bad. Automobile insurance rates are going up. If you would look at a graph, you could see that the auto insurance business back in 2020 was incredibly profitable because why? No one was driving cars. Everybody was stuck in their homes for COVID. Well, once the COVID epidemic subsided, people are back on the roads again, causing accidents and damages to their cars. The cost to repair automobiles has exponentially gone up. The number of accidents have exponentially gone up because people are back out on the road again. And somehow or another, they got the idea that they can be a little bit more crazy in terms of their driving habits, and thus causing more and more accidents. So between the two, the rising cost of repairs and the number of claim or accidents that keep occurring, those rates are going up too. Again, if you've tried to get certain cars repaired, I mean, if you've got a Tesla and it's in an accident, you take it to the Tesla dealer and they're going to tell you it may be 6 months before the part can come in. So you have to rent a car for that 6 months. That's a cost that goes into the claim that's exponentially going up too. So those are just some factors that are causing in the auto insurance business to the rates to go up. And it's becoming more and more the case. The last issue there about the deductibles being raised. Again, if you've opened your insurance, homeowners insurance, you're liable to see that wind and hail deductible automatically being raised to at least 2%, as opposed to the historical 1%. And there are some carriers that I've heard are taking the position that 2 is not enough, 3 is better. So what that basically means in terms that we can all deal with is that we as consumers are basically going to have to self-insure the cost to replace roofs. So from a financial planning standpoint, you're going to have a fund set aside to cover the cost to replace your roof in the event of a hailstorm in the coming years. Because the insurance company, by raising those deductibles to 2 and 3%, are basically getting out of the game. So that is just another way you're self-insuring that exposure. So you need to have the funds set aside to be able to fund those losses. And of course, in our world in North Texas, again, it's not the if, it's the when the hailstorm comes. And you need to get it repaired, obviously, but you're going to have the funds to write the check yourself. So that's something to keep in mind as we go forward. Again, you can look at some of these, again, the short list of carriers. This last one, that Demotech insolvencies, those are the carriers that have popped up that are, providing paper, but they don't have the financial resources to take care of catastrophes. So they're one storm short of insolvency. So if your clients have insurance policies that are not AM Best rated, if one of the any of these primary carriers you see on the screen they may be taking more chances than they know. Just because they get a low premium doesn't necessarily mean they get coverage. So it's important to understand the financial stability of the company that is insuring your personal property, your homes and your autos. Because if their resources are slim, if their resources are sketchy, they're not going to be able to meet a demand for paying claims in the aftermath of a catastrophe. And usually, whether it's a tornado in Texas, whether it's a hurricane on the coast, they may be the ones that come to the table and say, oh, we're out, we have no money, we can't pay the claims. So that's why it's very important to understand the financial capabilities of the insurance carrier that you're working with. So again, we've kind of touched a little bit on this. Why is the appetite tightening? Well, there are more and more natural catastrophes. We've talked incessantly about the wildfires in the West, the Texas freeze from a couple of years ago that caused billions of dollars in claims to be paid. All of these things are adding up. The number of automobile claims are causing underwriters angst, because again, we get back to that they're paying out more in claims than they're taking in premiums, and they're not going to run that race very long before something has to happen. So when they tighten their appetite, they're looking only for the creme de la creme, of risks that they're willing to, extend terms for. And again, that becomes a situation where, as a consumer, you want your risk profile to look better than someone else's, so you get the terms and conditions, and your neighbor doesn't, because that's really how it's happening now. Is that underwriters in their effort to so-called clean up their book of business are looking only for the best possible risks that they are being presented with. So the better the risk profile, the more likely is that terms will be offered. And we'll go through a few things that you as a consumer can do to help make that profile look better, and have a much stronger position when it gets down to having terms offered, as opposed to saying, you don't qualify. So again, this is some more of the why, in terms of, you look at the billion-dollar events that have occurred in the last couple of years. Now, again, understand it, B as in billion, claims that are being paid out, and just do the math real quick. That is, huge. We talked about that. We always see Texas hail. We had the Texas freeze. The wildfires are occurring all over the place now. Tornado activities, all of these things are coming more frequently and more severely than in the past. Historically, insurance carriers would go, 1, 2, 3, 4 years with no big storms, and then they'd have a big storm, and then another 2 or 3 or maybe 4 years, no big storms, and then a big storm. So it would spike, okay? But there would be level years where they were making a profit. Unfortunately, now everything's at the high end. It's catastrophe after catastrophe after catastrophe that just keep backing up, one after the other. And the cost to deal with these catastrophes has, again, exponentially increased. The cost to rebuild property has increased. The cost to repair cars has increased. So couple that with frequency, and that's just a recipe for financial disaster on the part of the insurance carriers. So again, the only alternative is to increase the premiums to try to offset the dollar claims that are being paid. So if somebody has an answer to the weather problem, please let us know. We'll take all suggestions to how to curb the unfortunate frequency and severity of Mother Nature taking her wrath out on us as a population. So you can kind of see this frequency problem just look at the graph. It's going up. It's not coming down. It's not going straight. It just keeps increasing. And that's a reason, again, why the premiums are going up. It's the frequency and severity of Mother Nature taking her wrath out on us. And again, there's no thought that that's going to change anytime soon. Again, if anybody's got the magic sauce to that, please share, because we're all in desperate need of trying to figure that one out. All right, so again, some more of the $1 billion type losses. Look at the graph. claims are being paid, and a lot of dollars are being paid out from, all of these natural disasters, the severe storms, the hurricanes, the floods that are occurring places. I tell people today, the reality of urban flooding is a real thing. You don't have to live near a body of water, i.e. a lake, an ocean, even a creek, to be subject to flooding today, because all you need is a thunderstorm to sit over your neighborhood for an hour or two and produce copious amounts of rain, and you will be involved in a flooding incident. So just, that's just another way to understand risk and how that can, impact, you as a consumer, and understand that floods are not covered under your standard homeowner policy. You have to get a separate flood policy to offset that gap. And you can kind of do the economics 101. The closer to water bodies that you live, the higher the premiums. But if you're living in an area that has a lower propensity for flooding, an inland type, environment, the cost for flood insurance is really nickels and dimes. I mean, we're talking a few $100s to take care of that problem if that thunderstorm sits over your house for an hour or two, and suddenly you have flooding into your home that now can be covered, but wouldn't be covered if you didn't take the precaution of getting a separate flooded policy. So keeping that in mind, I tell that to all prospects and clients that, it's a choice. I mean, no, unless your mortgage company demands that you have flood insurance, and then that means you live in a high flood risk. You're more likely to have flood. But even if you're not mandated, having that coverage for a few $100s is probably a good spend, just in case. It's not a big dollar spend, but you only need it when you need it. And instead of writing maybe a six-figure check to repair your home as a result of a flood, you've only paid out in premiums a few $100s, or maybe even a few $1,000s over years to protect the asset of which you have ownership of. So just kind of keep that in mind as you go through your day-to-day activities. That's a coverage that many people overlook or think that I don't live in a flood zone. Well, yes, you do. You just live in a low risk flood zone, but every community is rated for floods. So keep that in mind. Water losses continue to rise. Now, water losses by themselves, I mean, hot water tanks exploding, dishwashers coming unglued, causing water to do damage to your home. That is the only insured peril that we have control over. Okay. And the control is a water shutoff system. You can install or have installed an automatic water shutoff system that when a certain flow of water exceeds the norm, the system will shut off the water from the curb. So there would be minimal water damage in the event of. So if more people back in a couple of years ago in the Texas freeze had the water shutoff system, the claims would have dramatically dropped, because the water wouldn't have run for 3 or 4 days while people were out of their homes. And when they came back, all of their floors, their walls, their furniture, everything was pretty much water soaked and destroyed. So that is the only peril that we have any degree of control over. We can't control the weather. So hail's going to hit your roofs. Tornadoes are going to suck up the houses. Fires are going to burn. But water can be controlled. I mean, it can be mitigated to a vast degree. So people that are building new homes, I tell them to get with the builder and install an automatic water shutoff system. It's going to make your life a lot easier. It's not a huge cost in terms of the cost to install this valve. Is basically, that's all it is. It's a electronic valve that monitors flow of water into the house. So any plumber, you could actually go to Home Depot and buy it, have a plumber install it, And, for depending on the size of the house, it may be a few $100s to a couple of thousand maybe to install that. Underwriters that are presented with risks that have had prior water loss claims will demand that an automatic water shutoff system be installed, or they will not issue terms at all. So again, if you're going to try to make your risk look better than your neighbors, if you've already installed a water shutoff system, either before or after a previous claim, you're going to look better in the eyes of that underwriter than someone who hasn't. So again, that is a kind of a word of the wise. If you've got the chance to look into that opportunity, I would strongly suggest doing just that. So because the claims keep going up, and that's all the way back to the freeze, especially in Texas. The personal automobile results, again, have been deteriorating ever since 2020. You can just look at the graph and see that they keep going up and up. And there's really, it may be leveling off, but it's still very, very high. So that's the reason your automobile rates are going up. It's because everybody's getting involved in accidents. And when you take it to the body shop, they're charging you a lot more money to repair your car because the parts and labor have gone up. Same thing on the repairs to your house. The cost for materials are up. The cost for labor is up. And that's just a pretty easy measure for understanding why, if it's an insured claim, why more dollars are being paid out than claims, than they're being taken in premiums. Again, rates are going up because of those things. And you can look at the percentages that are taking place and the loss ratios that are going in. And the bigger this number, obviously, is less profitability for the insurance carrier. And so, again, their only means of recouping that on a go-forward basis is to, increase the premiums. So this is, what can individuals do to impact, the rates and their insurability? Again, we talked about, frequency and severity. I can tell you this, having, been an underwriter, frequency is more of a problem to an underwriter than severity. If they see 2 or 3 of the same kind of claim that are even zero pays, they are more likely to say no than a total fire loss. If and I've had this happen already, a couple of people that had turned in some windshield claims, over maybe a 5-year period, they had 3 windshield claims. Underwriters will look at that and say, "Oh, no, we don't want to touch it. We don't want to have anything to do with this, with this risk." So, okay. So what had happened is no one told the client that after the first windshield, the second and third and fourth windshield that they had replaced was going to cause them problems down the road. It's going to make them basically uninsurable in many cases because, again, frequency is a problem. Even if it's, a few $100s, underwriters look at that much more carefully than they do severity. So not turning in the windshield claim, again, I would give anybody advice. The first one may be free, but the second and third and fourth one after that are going to cost you way more than, the cost to take it to SafeLight and have it replaced. We talked about, mitigation after loss, what you can do, what you can do in terms of keeping being more safe when you drive and be more aware. The at-fault accident problem is just as big of a deal today. Even not at fault, wrong place, wrong time, it can be an issue. Again, it's another reason that underwriters can say, no. Even you say, well, it wasn't my fault. Well, you're right, except a claim got involved. They didn't have insurance. Their limits were too low. So, your insurance company had to pay for damages as someone else's fault. And that's another reason to talk about, uninsured, underinsured motorist coverage should always be the same limit as your primary liability limits. Don't skimp on that, because that's going to come back to haunt you sooner than later. Because unfortunately, the number of people that are driving today without insurance or with state minimum limits is increasingly higher, and some for good reasons. They can't afford it, but they find the minimum limits just to get their tags and be legal. Except they're the ones that come out and they cause damage to you and your cars. The low limits, again, we talked about that. You need to have limits that are commensurate with what your exposures are. Most insurance carriers, especially on the automobile, require certain minimum limits to sit under your personal umbrella, which you should be having anyway, and be able to make sure that you're protected in the event that you are involved in an accident, and people that are in your vehicle can have the coverages to take care of the injuries that may be as a result of that accident. The carriers are looking, it's not, loyalty is not as big of a deal as it used to be. Although if you're with a carrier and they haven't non-renewed you, that's a good thing. The days of shopping for insurance pricing is pretty much a thing of the past. In years past, people would look to shop every year, and they would move from carrier to carrier for $50. Okay, those things aren't happening anymore. Or are they? If they are, they're very unlikely. So staying with a carrier, like I said before, if you get a renewal, that's a good thing. That's a very good thing. Obviously you want to, in terms of keeping the account with the same carrier, I hate to use the word bundle because that kind of floats down to, just strictly a price-based kind of a deal. But consolidating your coverages, if at all possible, with the same carrier is a better play than not. So there's usually some financial benefit because the carriers will offer credits for having the home and the auto and the umbrella together, as opposed to having one or the other by itself. The other problem that we find now is there are fewer carriers that will only write a single home or single autos by themselves. So again, that's part of that shrinking capacity that we're seeing more and more of. So here's some more strategies that we can talk about. We know rates are going up, capacity is going down, renewals are being, looked at with a jaundiced eye, and 15 minutes is not enough. The idea of, trying to get, a lower premium by picking up the phone and calling, pick an animal, a gecko or whatever it may be, is not necessarily the best track to go down. The idea, and I don't even see the commercial anymore. And don't misunderstand, I'm not going to necessarily throw in Progressive under the table or under the bus, but the name your price tool that used to be so prevalent a few years ago is a simple matter of, you tell us what you want to pay, and we'll reduce the coverage to make that number look right. Again, I haven't seen that commercial in quite a while because, again, the idea of doing that now is, they're trying to get, profitability as well as everybody else, and they're looking for the same types of risks. So home, auto, umbrellas are what they're looking to take care of, and offer the quality coverages that are commensurate with what the client has at stake. Again, I'm also having more and more conversations with clients about self-insuring. We talked about how deductibles in some respect are self-insured, a large portion of your risk. But apart from that, conversations with clients about especially property assets that, you feel that you're willing to take the risk in terms of if that is lost or damaged yourself, as opposed to paying the premium. And that conversation is occurring more and more. But it's a conversation of informed decisions. You understand what the risks are, and you're willing to accept them, and you can financially cover the replacement of that asset in the event of a loss. Some people say, I don't care if it goes away, I won't replace it. Great. Okay, but as long as you understand that and don't have expectations of coverage after it's gone, and then be disappointed in the fact that you say, "Wait a minute, what the hell is this insurance for?" Well, because making informed decisions is what it's all about. Uh, you know, you want to know what you want to transfer risk for and what not to. Some clients have a different appetite for risk, and understanding that appetite and capacity is important. Like I think we said before, working with your financial advisor to understand how much in the bucket you have to pay for certain assets in the event that they're no longer available. If you've got it and you are willing to, not transfer the risk, then that's fine. And again, property is probably the biggest thing of risk transfer that you have some control over, and making those decisions. I mean, I have clients that are willing to self-insure their homes. They're willing to, they have the capacity to write the check. And so they're willing to take the risk because their premiums have exponentially gone up. And they're saying, well, what the heck? If I'm going to pay a 6-figure premium for a 7-figure home, how many years is it going to take me to cover the spread? And they're willing to take that risk. But you've got to have the financial resources to be able to make those decisions effective. And that's where working with your financial advisor is hugely important to make sure that all the bases are covered and you're not going to be disappointed. Talked about deductibles. Yes, higher deductibles are going to be something, you're going to be forced with. I mean, on the homes. The other deductible issue you can look at in terms of like your automobile insurance, looking to see if there's enough of a credit to take a $2,500 deductible instead of a $500 or $1,000. And again, not turning in small claims. I tell clients all the time, call me first and let's have a conversation. Again, it might be better for you to pay for that windshield. It might be better for you to pay for that, the rear bumper that got smashed yourself than turning in a claim. Keeping that in mind, insurance is for catastrophic loss. It is not a home warranty program. And I think the reality of that is starting to sink in with a lot of consumers, that's what's happening now. And you understand, again, the original basis for insurance was just that, catastrophic. It kind of evolved into more of a home warranty program, and it's fading away fast. So kind of, as long as you understand that and know that, how that affects you on a personal financial basis, I think is significantly important. Again, windshield claims, roadside claims. Oh my goodness, I've had people that when you ran the report, find out they had 5 towing claims. I had one client that was, we looked at the review and he had like 7 towing claims. I said, what happened here? He said, well, I have collector cars and my former insurance person said I had towing coverage. And so whenever I need them to get it serviced, I just told to call the towing service because they said, hey, come get my car, take it in, get it serviced and bring it back. Well, he did. And then it took, at the time, some talking to the underwriter to get them to agree to, offer terms. Today, that wouldn't work. If there are claims on the books and in the database, underwriters will say no. No ifs, ands, or buts, no exceptions at all. So understand that paying for small claims individually now is something that needs to be considered much more strongly than ever before. All right, I think we're down here to the questions and answers. Hopefully, I've helped enlighten you just to the issues and some of the whys that's taking place. So, if there are some questions, please let's share and see if we can help out some more.
Oh, Cliff, you are a vast font of information. I mean, I have taken 2 enormous pages of notes here, and I see one of our George has said that one of the reasons that why our increase in frequency of claims is due to climate change. Not really a question, but more of a statement, which I am not disagreeing with George right here. I think he's got a good handle on that, and I'm not really sure how we're going to be able to change that, George, in a quick way. But it does lead me to a question, which is sometimes we've heard, like in Florida and places like this, maybe you can address this, Cliff. They have some insurers of last resort, like the state can sometimes be an insurer of last resort in some
Yeah.
of these places. Can you talk a little bit about that? What does that look like?
Well, again, it's like any other governmental entity in terms of dealing with individuals. My daughter and son-in-law live in Northern California, and they were buying a new home a few months ago. And when they were in the process, I asked my son-in-law. I said, "Now, is the insurance you got that covered up pretty good?" And he said, "Oh yeah, yeah. I'm told everything is fine," until it got down to closing, and then they said, "Oops." So I got a call and said, "Hey, Dad, we need some help." So, I picked up the phone and called one of our colleagues in California, in Sacramento, and they were able to put something together. Basically, they gave them fire coverage from the state, to cover fire because all the other carriers were excluding fire as a peril, and then added a regular homeowner policy without fire coverage. So they have two policies to try to wrap around all the exposures. Now, the problem with the state's last resort, whether it's the California Fair Plan, whether it's Citizens in Florida, they are basically, again, they're maybe a big storm away from insolvency. They're trying to
Right.
depopulate it because they know that they can't come to the table in the event of a catastrophic storm. Another Ian hits Florida. The citizens doesn't have the money. They don't have the reserves to pay those kinds of that level of claim again. So it's it is by definition the avenue of last resort, and that should scare a lot of people because again, that is there are no other options. I mean, it gives you something, but maybe not anywhere near what your expectations are or should be for your risk exposures. So, I mean, it's again, it's a sad state of affairs that it gets down to, that's your only option. And I mean, it's better than zero, but it's not nearly as good as it could or should be in terms of risk and
So
transferring.
if your daughter and son-in-law's house gets burned,
Yes.
they will not get anywhere near the value of their home. Is
Yes.
that what you're implying?
Absolutely. Absolutely. They
Okay.
will get something, but not a lot to
Okay.
replace their house if a fire came along. It's
Okay.
just it is a band-aid to say the least. A small
Okay.
band-aid on a big cut.
Well, that doesn't sound very wonderful. Um,
And
one of our other wonderful financial planners here, Patty Hammond, says she got a quote for a water shutoff system, and they suggested a shutoff at each source of water, kitchen, bath, etc. Do I need that or a single shutoff at the main? So I wanted to suggest, so here's what we have at our house here, Patty. I'll just tell you what we have and then Cliff can answer. We have a flow by Moen, which is at the main that comes into our house, and it shuts off if we run a certain amount of water that comes through, and it'll shut it off. So, but let me tell you right now, we had 5 people or 6 people visiting. A lot of them were taking showers at the same time, we're running the washing machine, dishwasher at the same time. It can shut right off if you're running a lot of showers at the same time, running the washing machine and the dishwasher at the same time. So be very, very careful about how you set your flow by Moen. But you get a credit on your, they give you that box is checked that if I'm out of town and some pipe bursts, it will shut it right off because I'm not going to have something running through my hot water heater and just pouring into my house. So, Cliff, why don't you answer that Patty question?
well, that's very much the answer. The only thing I've been told is that there are some manual shutoffs that you can utilize when you have exactly your situation. When you have guests over, there is a manual override, or should be a manual override, that you can deal with for those occasions.
Well, and Kirk does that. He has it on his phone. My husband has it on his phone,
yeah,
so he can go turn it back on again.
right.
You know, so it used to happen. I think he's made it less stringent because he can because you know it would sometimes just arbitrarily turn off in the middle of the night, and we would wake up in the morning and there'd be no water. And
Yeah,
so
well,
that was a little exciting.
yeah, technology is a good thing in some respects. Other things, it's a little bit more of a hazard. But as you've understood by having it done, it's more of a plus than a minus. It may be somewhat of an aggravation sometimes, but when push comes to shove, you're right. If you're gone for the weekend and something happens, and you come home and you've got 4 or 5 inches of water in your home, several years ago, we were at the house and the see what was it? The city turned the water off for some reason. They were doing repairs, and so unfortunately, we someone was at the sink at the time, and when the water got shut off, right? Okay, we didn't realize that we needed to shut off the water valve because when we came home after being gone for the day, water had been coming out because they turned the water back on, right? And water was, flew through the sink, got on the carpet. It was a mess. That was pre-automatic water shutoff system. I'm just saying that those kinds of things have occurred and can occur pretty easily, whether it's something as simple as that or being gone and we have the freezes or the hot water tank decides it's time to give it up. This is something that is well worth the spend.
Patty, I think maybe you need to think about doing it at the main, and then I don't know, maybe you do it if you have certain, like the hot water heater or other places too that you want it to be double careful. Maybe you do it at double places. So let me ask you a question about these ads I sometimes see, Cliff, about these apps you can get on your phone and things about smart drivers and stuff like this, which seems very big brother. And I'm not sure I want my insurance company watching me drive all the time, because sometimes, maybe I'm a little more aggressive than I should be in my driving. So tell me some about those apps and tell me, do they make a difference? A, and B, do they are they do you suggest we use them or not use them? I don't like Big Brother. I don't want them in my biz.
Well, what I'll tell you is this, and I've had this conversation a lot with the technology that's available. If you are by nature, you and or anyone that drives in your family, okay, everyone that drives in your family is very cautious by nature, then they can save you some serious money. Okay. But you have to be, and I say you, anyone that drives the cars, not just personally you, your spouse, your kids, if you're on it, you're on it. And it can come back to bite you if you have it on there and you become aggressive because they see it, and that 30% credit will eviscerate and will go the other way. So you have to make that decision early on as to, are you, if you're really by nature very careful, you stop at every stop sign, you don't do rolling stops, you stay the speed limit, if you do that, if that's your nature of driving, then that is a good way to save some serious money. If you're not, if you do tend to, be a little more aggressive, if all these things, then it's probably not worth the effort. Now, Big Brother notwithstanding, I mean, it's some of this stuff is ultimately will be built into the car anyway. Now, right now, it's all apps. Okay, you have a choice. In the years to come, you may not. But right now, I tell clients, look at your driving history and habits, and if it makes sense to take on those apps, yes. If it could come back, if you don't think that it's going to be good for you and your family, then probably stay away from it.
So presumably, right, people who are cautious drivers are going to self-select that, right?
Right.
And so insurance companies should probably already know that, right? So
I mean, right
maybe
now it's
they're
a choice. You know,
what?
everybody, the consumer has a choice to sign up for it. They're not mandating that you must.
Okay.
Okay.
All right.
For now. So if you have a choice, you make the choice based on your driving habits and your way of driving day to day to either save you some money or not.
Got it.
I have a
Okay. So
couple of questions. Sorry, go
okay.
ahead, Eleanor.
Oh, I'm sorry. Just one more question, Deborah, and then you ask all the questions that you want. Now I'm looking at it as a financial planner, and I'm thinking about investing in insurance companies. And some people on this call may or may not be invested in insurance companies and reinsurance companies like Lloyd's of London and people like that. And I'm thinking that maybe it used to be really good money to be made investing in insurance companies, right? Especially when there were those lull years where we weren't having catastrophes every year to the tune of billions of dollars. And now I'm thinking maybe not so much. And so there may be some not so much money to be made in those situations. So is that something that we should be thinking about as well?
Probably. Probably so. I mean, there
Okay.
may be a few exceptions, but you're right. I mean, a few years ago, that was pretty much a given that there was money to be made in buying stock in, publicly traded insurance companies. All right.
Right.
It's a much more cautious play today. If
We
you
need to
start
do some due diligence there.
serious due diligence today.
Okay.
Okay. What
Deborah,
else?
go ahead. Deborah, ask away.
Cliff, I wanted to go back what you mentioned about roadside assistance,
Yes.
because certainly we have that and I know a lot of clients do have that just as part of their auto insurance.
Yep.
Now, what happens though, like if you have, and because it's not very expensive to have it as part of your insurance policy, but if you use it because you have a flat tire, someone comes out and helps you with a flat tire, is that going to also impact your insurance premiums potentially going forward?
Well, what I said is usually you've got the first one is free. I mean, you're not going to
So
be
just
dinged.
getting someone coming out to you,
Yes.
that's going to put okay. So
It's-
it may be better off than having that as a separate service, sort of outside of your auto insurance.
Well, what I would suggest too, I mean, especially on roadside assistance, is that whether it's AAA or some other kind of operation like that will not show up
AAA.
on your insurance, that's thank you.
AAA.
Yeah. Okay, yeah, there you go. See?
I buy it for my whole family. Merry Christmas every year. Here you go.
Okay.
AAA.
So that's, taking that as opposed to turning in an insurance claim is a better play to make. Okay. Now, again, you're not going to get dinged for that one time, you got caught out in the middle of nowhere and you had a flat tire and you had to, call someone in. But if you didn't have to do that and you could call AAA, that would be a much better picture. Again, we get back to frequency more so than severity, but AAA is a way you can defer from going to an insurance carrier, right? Now, glass breakage is a little bit different. Unfortunately, the insurance companies have been their own worst enemy by offering free glass, 100% free glass. People are, heck, let's let them pay for the whole thing. Maybe not so much. So keeping those things that you have control over and discovering if you can write the check, it's probably better to do it than turning in as an insurance claim. But
and that would hold same true then for a new roof. If
yes.
you can afford it, you're generally better off to pay it out of pocket as opposed to putting through insurance.
Yeah, and that pretty much applies to anything now.
Yeah.
Whether it's a roof claim, whether it's a small water damage claim, anything that you can afford to pay for yourself, it's probably a good idea not to turn in the claim. Now, again, this is the conversation between you and your insurance person as to what that might look like. But I think it's worth a conversation.
Sure. Right.
Okay.
I know we're near the top of the hour.
Okay,
but sorry, one other quick comment that I wanted to share too is that for those of you who may have young drivers in your household, is make sure that, because obviously the auto insurance premiums certainly go up, make sure you have probably some umbrella liability insurance. and help them get to develop some credit, because not having good credit or not having a credit history will really impact them when they do want to go out on their own and get their own insurance, because the premiums will be really much higher if they don't have a good credit history.
Or suggest that they take a bicycle. You know, I think cardio fit is important. Very important.
Absolutely.
And one more quick question, Cliff, if I am, like if I'm insured through XYZ insurance company and they, you know, and I've had a couple of claims or whatever, and they say, guess what, Mrs. Baker, now we're not going to insure you anymore because you've had these spurious claims or whatever, not spurious, but, you know, I made a mistake and I claimed these things. And then I go out to ABC Insurance Company and ask them to insure me. Can they see the claims that I had on XYZ Insurance Company? How
Yes.
can they see that? If that's not private?
No, it's a database. Every claim that any insurance company deals with goes into a huge database. It's effectively called Clue, that everything shows up. From
Really?
zero, yes, you can't hide it.
Oh, that's kind of disheartening.
Sorry about that. Yeah,
Well,
you can't hide it anymore. It's there.
All right, Deborah, you have anything else? We're at the top of the hour.
No, I just thank you so much to you, Cliff, and all joining, and I'll let you wrap it up, Eleanor.
Well, thank you, Cliff. You have been, I mean, I'm scared. I'm nervous. Thank you also very much, all you friendly clients, for joining us. I hope you guys have learned a lot. And I hope you're not scared, but if you have any other questions for Cliff, you know, you can always contact your Carter Financial Advisor, and ask us to get you in touch with Cliff, or ask us to follow up with any questions for him, and you know, search out your insurance policies, dig them out, brush them off, figure out what you've got, make sure that everybody that you're being insured by has AM Best, has you know, that you are actually being insured by high quality people, as Cliff suggests. Cliff, we can't thank you enough for this. This has been really, really, really interesting, and we look forward to another one of these in the future, and we hope everybody has gotten a lot of their questions answered, and we look forward to seeing you all at the next Carter Advantage Education Series. And Shred Day. Don't forget Shred Day.
Thanks,
okay.
all. Take care.
Thanks, everybody. Bye-bye.
Bye.
Bye.